think we'll get started. Thank you so much for inviting us to come and visit with you about an industry we all care about. All my co-speakers who are not ISRI guys are making fun of me because I'm sitting over there in the corner snapping photographs as the Lifetime Achievement Awards are given out, because those guys are rock stars to me. I grew up in this industry. I've been coming to ISRI conferences since I was literally, I'm not joking, 4 years old, walking around with my dad and my brother and so on. So, I grew up with Toby Shine. I grew up watching Newell Industries. That was a pretty cool segment, I have to tell you.
Tim, actually, we were laughing at each other for wearing ties.
So today we're going to talk about the economy. We're going to talk about where it's headed, and specifically about its effects on metals markets. We're going to attempt to do three things today. Number one, we're going to share our outlook. We're going to share where we think not only the economy is going, but the various different scenarios and what that might do to metals markets. Number two is we're going to try to challenge you. We're certainly going to try to challenge conventional wisdom about what's going on in the world and what's going on in the metals markets, because I think some of the things we'll suggest are different than what's been talked about at least yesterday. And number three is we might offer some practical opportunities that even though the world looks a little dim in the metals world right now, we think there's some great opportunities out there. So let me start out by some introductions. Immediately to my left is Rick Rule. Rick is chairman of Sprott U.S. Holdings. They manage about, goodness, what is it, $4 billion or so in a precious metals portfolio that Rick runs. To his left is Doug Hepworth. Doug is a portfolio manager with Gresham. He's been at it for about 15 years. They manage a little bit over $11 billion, of which Doug controls half of in the precious metals markets as well. So welcome, gentlemen. Thanks for joining us.
Thank you.
So let me get started here. My hope is that I get to share two great opportunities with you today. And I call them opportunities in a market that looks so ugly. And you say, what opportunities could there be? I think there are two enormous opportunities today. The first opportunity is to take advantage of this dip in the world and use it to transfer wealth. And what I mean by that is most of the businesses that have been built in this industry are family businesses. And as family businesses, we transfer them from generation to generation. And today's depressed prices provide an opportunity for you to step back, look at your businesses and say, here's an opportunity to avoid millions upon millions upon millions of dollars in estate taxes. Those opportunities can be done with three things that most of you didn't think were possible years ago, and certainly your fathers and mothers didn't think were possible. Yes, you can transfer your businesses today, and you can still maintain complete control. You can still maintain all the income out of the business, and you can eliminate all of that massive taxation to your heirs. The second great opportunity that I think that is out there right now is the opportunity to do something that isn't just surviving. We all say, well, let's just wait till the next great bull market. Let's just wait till the next great commodities super run. But I think there's an opportunity today for those of us that want to be very entrepreneuristic. That opportunity is to look for these companies that have gotten extraordinarily highly leveraged in the marketplace today, and to go to the banks and the mezz funds that own these companies, or at least own the control of these companies, and grab market share today. In a few moments, I'm going to share with you at least my overview of where I think the economy is moving, and what you'll see in that is I think there's a clear indicator of when this market's going to change. And if you're able to acquire market share, if you're able to acquire contracts for scrap and make it to that next cycle, I think you're going to be extraordinarily positioned, and I think we have a once-in-a-generation opportunity to grab that market share out there. So let me get started, and I'll start out with kind of my view, and then I'll ask each of you to share. At IFAM, we believe all economies have cycles, and this economy is no different. These economies recently have been very disappointing in everywhere but the US. Even Germany has turned kind of disappointing recently. But as they're disappointing, they certainly have a pattern. And this pattern is important to realizing where opportunity exists. As you can see in this pattern, there's a mid and a late cycle. And the mid cycle has growth that's peaking. It has profits that are peaking. And it's found this kind of equilibrium between inventories and sales, where everything's kind of balanced. And another way of saying it is things are going really well. And outside this industry in the United States, it looks pretty much that way. The next cycle that I would argue that we're very, very, very close to in the United States, and most of the rest of the world, like China and Japan, and is already in, is growth is moderating, that earnings are under massive pressure, that growth in general, sales growth and so on, is falling. If this is true, and this is happening, it's really important, because if you look at that kind of green, yellow, red line going across the top, the red's when inflation happens, and when inflation comes, of course, commodity prices go up. I think we're closer than you might think. Don't get me wrong, I'm not saying it's next quarter or 6 months from now or even 9 months from now, but I again think the smart opportunities to go out and acquire market share right now, because when this cycle moves, we'll have opportunity. What's this look like? Well, this is a heat chart, and what it just shows is the post-crisis time period here. And the green is when there's extraordinary easing put out by the world's Federal Reserves. You'll see in the first 3 columns there that the United States, the United Kingdom are always in the green. But you'll see the green switches by the last column here, which is the 4th quarter of last year. The general idea here is that cash follows easing. In other words, when people make money very available, investment follows to those areas or those countries. Well, look in the bottom right. Look who's easing now. Look where opportunity exists. And it's not the United States anymore. It's China, Europe, and Japan. The opportunity exists, I think, again, because this is going to promote an opportunity to capture market share. Why am I so convinced this is going to happen? Well, this is a chart that takes a look at 1996 through 1998, and it has 2 bars on it, as you can see. The blue bar is basically the dollar, and the gold bar is oil. You'll see how they cross in 96 through 98. Move it forward to today on the right-hand side. Anything look familiar? In other words, as oil prices crash, the dollar goes up in 96 through 99. Does that look familiar today? The same exact pattern is happening here. I don't think this is by chance. Now, what does that mean to scrap prices? Well, if we go back and look at scrap prices in that 96 to 98 area, we basically went, if you use non-ferrous as the example here, you basically went from about 174, 176 down into the 120s. Then you have this super cycle for commodities that occurs. If that same cross is going to occur again, you'll see the drop in commodities on the right-hand side there that's roughly the exact same percentage. You're also going to have another, maybe not super cycle, but run is my point to you. So what we're trying to say here is that when the dollar declines, that's the trigger. That's where there's opportunity. And what causes the dollar to decline is interest rates being triggered to finally start going up. Well, you say, well, interest rates haven't gone up yet, and we certainly agree with that. So the massive question is, when will interest rates start going up? Well, we're no better than anybody else, but we'll give you what we think are the triggers anyway. The chart in the upper left-hand corner is what most economists look at. When they would say that interest rates go up when there's wage inflation, and when unemployment drops, right, when more people are employed, then the labor market gets more competitive. And when it gets more competitive, you have to pay more for labor. Well, why hasn't that happened this time? Because as you can clearly see in the upper left-hand chart there, unemployment has declined. Well, in the blue line below it, you could see that there has been no wage pressure. That blue line in the bottom there just shows that wages have actually gone down. Why is that? Well, the first thing we'd argue is that the participation rate is changing. As we get older, there's less and less people that are working, and more people have decided to work part-time or have decided to retire early. But of course, the big one's in the upper right-hand corner, and that's productivity. We've simply figured out how to do more with less people. I think everybody in this room can say that they figured that out in the last 5 years, how to run their business with less people. My point to that is, if the key to interest rates going up is wage pressures, then you have to get to a point where you've exhausted that productivity, you've exhausted that opportunity, if you will. We think we're getting pretty close to that. We think we're getting to the end of the rope where the Fed's going to run out of options and have to increase interest rates. But our big conclusion that we want to leave you with is that the markets, the commodity markets that we're all interested in this room, they'll get better when the dollar falls. The dollar will fall only when interest rates finally are set to go up. And interest rates will finally set to go up when wages finally become pressured. So that's kind of our view of what's going to happen here. And I'd turn it over to Rick, and let's get 5 minutes from you about what you think is going to happen.
Thank you, Tim, and thank you, ladies and gentlemen. I'm going to start in a strange way, but I've put on a lot of conferences like this in my life, and I got to say, it's a horrible job. So I'd like the audience to join me in thanking the sponsors and Tim for this wonderful affair. It's a lot of work. The message that I'd like to give you, and this is a very friendly audience to give it to, is that markets work. Many people don't understand the nature of commodities markets, but you all do understand the nature of commodities markets. Somebody needs to tell Washington or Ottawa, and I suspect it'll be ISRI, that the cure for high prices has always been high prices. And the cure for low prices will always be low prices. At Sprott, we've been in commodity markets, or more properly in commodities investment management, debt and equities, for 3 generations. And what we know is that very good times are followed by very bad times. These industries are capital intensive and they're cyclical. And oddly, what that means is that the cycles go longer and the cycles go more radically than they would in more rational businesses. The truth is that prices rise in times like this for one of 2 reasons. You can have demand creation, or you can have supply destruction. And we're in a race between demand creation and supply destruction. With regard to demand creation, the cycles are less extreme because the recovery in commodity prices take place before too much capacity is destroyed. I'll try and show you a little bit later in this talk, and I don't mean way later, like 2 minutes from now, why I believe that supply destruction will be the answer to this cycle, and why that will be of substantial benefit to the wise and the strong in this group. But the truth is, in capital-intensive cyclical businesses, when the selling price of the commodity goes below the total cost of production, the industry will continue to produce. And by this industry, I don't mean rational industries like yours. I mean irrational industries like mine, the mining industry. We will continue to produce below the total cost of production to win something stupid called the last man standing contest. But when we've done this, when we've capitalized the capital that we've built up during the good cycles, and we've destroyed productive capacity, and the market begins to rise, by the market I mean commodity prices, the demand response is very, very slow because we have destroyed the capacity to increase supply in the near term. So what I want to leave you with is that markets work, and the low prices that we're beginning to experience now will solve themselves. Let's talk about the incredible period that we just survived. And I'm going to suggest to you that the stimulus that we've seen in major markets, but especially our own, and by our own, most of us in the room are Americans, so I mean the American market, going back really to the stimulus that was supplied during 2000 after the hiatus in equity markets with the tech wreck, really had the effect, I think, in the United States, but in around the world, of forward-shifting demand. We had a situation where normal economic cycles were disrupted by fiscal policy. The consequence of that was an extraordinary party that we all enjoyed in the middle part of the last decade. But all good parties, as many of you who were out last night have figured out, end less happily than they began. And forward-shifting the demand in 2000, and forward-shifting the demand in 2004, and forward-shifting the demand really wholesale in 2008, 2009, has led to the consequence that much of the demand that we would like to enjoy today, we enjoyed 5 or 6 years ago, and we need to work through all that. The good news is that we're doing precisely that. Your competitor, I guess, in the mining business, we are well into capital cannibalization. In the base metals mining business, as an example, perversely during periods of very low interest rates, the senior tranche of production or mine development financing, the cost of capital has gone up by 30 or 35% in the last 5 years, which I assure you will constrain the market's supply response. The average head grade, as an example, of a new copper mine has fallen by 50% in 5 or 6 years, which means that their unit costs go up at the same time that their revenues go down. The social take for mining around the world has skyrocketed. One example would be Zambia, where the fiscal regime in Zambia used to be a 5% net smelter revenue royalty, and the current government proposal is a 20% net smelter revenue, which exceeds, by the way, the gross margin that the industry enjoys in that country. So if you have a situation where you are producing below total cost, where your new production is burdened by a 30% higher cost of capital, and what is, relative to your margin, an infinite social take, tells you simply that the cure to these low prices will be these low prices. The response, the message I'd like to give you is precisely the message that Tim left you with. If the cure to low prices is low prices, what you learn in your business, as we've learned in our business, is that you have to be a contrarian or you will be a victim, because this situation will change, and it will change dramatically. My friend Doug Casey once told me that a bear market doesn't destroy wealth, it just returns it to its rightful owners. And while that may be a very, very cynical statement, it is also a true statement. So you need to decide yourself with regards to your business in our industry, the metals industry. Will you be a contrarian or will you be a victim? Thank you.
Thanks, Rick. Doug, you want to share just what your thoughts are on the overall and general directions?
Sure. Look, there's a lot that's good out there, and I think both Tim and Rick touched upon it. About 30 years ago, somebody did an analysis of prognostication, and they found that there were actually only 2 kinds of predictors that failed to meet the naive forecast, and that was the weathermen and economists. And it turned out if you were a weatherman and you just went on TV every day and said that tomorrow's weather is going to be just like today's, you would have been above average as a weatherman. And if you said that the economy was going to do about the same as it's been doing, you would have been an above average economist. So I'm actually going to try and be somewhat of an above average economist here. Actually, the weather prediction over the last 30 years has gotten significantly better. So it just leaves economics solely in that role. There are, I think, a couple of things that are generally misunderstood in the media. The thought is that the U.S. has been incredibly accommodative with monetary policy over this last 7 years since the crisis. But the reality is that the crisis was a credit crisis, and when you have a credit crisis, what you end up with is a paucity of credit. So the entire $3 trillion that the Fed has added to its balance sheet has been offset by a $3 trillion decline in bank balance sheets. So if you look at the money supply from the perspective of M4, Divisia M4, it's basically flat. It has not been all that accommodative. So that goes somewhat to explain, why we've had this lackluster growth. Furthermore, you might argue that in fact the policy has been even less accommodative because regulatory activity is pro-cyclical. by regulators coming down on banks, they're stepping on their already meager desire to lend to the real world. What Rick talked about the cost of capital, that's a direct result of this. People are paying too much for credit. So that's terrible news, but it's also good news. It means there actually is a tremendous amount of capacity for growth. There's potential fuel for growth, even in America, which has been the highlight of the world. So if you're the Fed, you're fairly happy right now. Things are going as you want. Because in fact you do actually have room to raise rates, and you also actually perversely have room to reduce them through more quantitative easing. But they're not doing quantitative easing; they're doing something else instead, which is encouraging a rise in the dollar. Because one of the points besides labor force participation and productivity is that low wages throughout the world effectively export low wages to the U.S. So if an engineered rise in the dollar effectively exports growth and exports higher wages to the rest of the world, we are trying to export inflation, and actually the world is a buyer. The world wants to import inflation. Japan would buy as much inflation as we could give them, and they are encouraging it. They actually felt that they missed the last 3 rounds of the competitive currency devaluation. They stepped out of the room and somebody else did it instead. They were particularly angry with Switzerland, who they didn't even think was in the game. So in fact, the U.S. has monetary room to grow, and a lot of people have touched upon the power of low energy prices to spur the global economy, and that just cannot be understated. Tremendous growth comes from lower energy prices. If you look at the world, if you look at the world's GDP, and you look at how much of that is composed of energy, historically, whenever energy gets to less than 6% of GDP, and that's oil, petroleum, and electricity, either energy prices are going to go up or the economy is going to grow. When it gets to over 9, kind of the obverse happens. So the U.S. is happy. Europe is actually finally coming to the realization. Europe, sort of waddling through, as we're going to talk about later, is intentional. You're starting to hear that Greece can default without even leaving the euro, and this is coming from a realization, really by Germany, that if anybody should be leaving the euro, it's them. All the other members of the euro are exactly alike. They're the ones who are different. So if you start playing the game of let's throw out the people who aren't like me, you're going to pretty much end up with a one-country euro, back to the D-mark. So they are happy with the way things are going, and I would say also China is not incredibly unhappy with the way things are going, in spite of the slow growth, maybe even because of the slow growth. I don't know if you remember 10 years ago, the thought was that if China grew less than 8%. They wouldn't be able to create enough jobs to get people out of the countryside into the city, and there would be riots. Well, now we're looking at 7% growth in China, and in fact, we're not seeing riots in the street. It's important to remember that for China, you do not promote stability to encourage growth. You promote growth to encourage stability. Stability is the product that they deliver. They are not a growth engine. Growth is a means to an end for them. So China is not unhappy with how things are going. They're not unhappy with the slowdown in growth, so long as it doesn't lead to social unrest. The thing to watch in China is environmental policy. So environmental policy is a catch-all for going to organizations that are not economically competitive and telling them to produce less, with the assumption that will take some of the corruption out of the lower ends of the economy, B, force people out of the shadow banking system back into the real banking system, and C, bring to light who actually is producing uneconomically.
Great, thanks, Doug. Rick, let me turn back to you and talk directly about metals and demand. So specifically comment a year out, maybe 18 months out, maybe 24 months out on U.S. industrial demand for the metals complex, if you will, emerging market demand, and any other specific markets you'd like to mention.
We see the U.S. as continuing to be fairly weak. We don't see any signs of increasing U.S. demand. One of the reasons that I came to this conference was to listen to your delegates. Hopefully tell me I'm wrong. In the commodities market,
they're not going to tell you that.
in the commodities markets, the sex, if you will, has come from China. But the U.S. is still the world's mouth. And we aren't seeing any particular signs of demand in the United States for the reasons that you yourself pointed out. Real wage growth hasn't been stalled in the United States for 4 years. It's been stalled in the United States for 20 years. We could talk about the political causes of that, but there's no particular point. Everybody in the room understands them. We don't see any hope coming from the U.S., which is the reason why I said that the most positive light for all of us is supply destruction rather than demand creation. We are more hopeful ourselves with regards to China. We manage a reasonable bit of money for large Chinese state-owned enterprises, including Zijin Mining, which is the largest non-ferrous metals mining company in China. And I guess about 14 months ago, Zijin told us, in terms of the investments that we make for and with them, to stop anything having to do with copper at all. They said no more copper. I wish I would have listened a little more carefully, personally, to that, by the way. 2 weeks ago, Chairman Chen said, start on copper, start on zinc, start on lead, start on nickel. So the view in China, from our point of view, from the opinion leaders in China, is that they are beginning to see the light at the end of the tunnel. With regards to Chinese state-owned enterprises, they have a very, very, very long time frame. And my suspicion is that they are telling us to start the investment process in copper to look at a copper market that they see as 3 years from now or 4 years from now, because they understand the length of time it takes to create supply in the market. From the Sprott point of view, we aren't looking for a profound economic recovery in the markets that we would hope to see them in. We're not looking for a recovery in Europe. We're not looking for a recovery in Japan. We're not looking for a recovery in North America, despite equity markets that would suggest that that recovery is imminent. We are looking for better economic conditions in emerging markets than most other commentators are calling for, simply because we operate in about 100 countries worldwide in exploration and production of metals and energy, and the signs that we're seeing on the ground are nascent economic recoveries, albeit in very, very small economies. But one thing that's been pointed out, and I think most of you know instinctively, is with regards to China in particular, 7% growth in an economy that's 3 times the size it was 10 years ago is much more aggregate growth than 10% growth in an economy 3 times the size. And we feel better about China. In fact, I think it's fair to say that Vancouver is a metaphor for China in 2 ways. One, the incredible rise in real estate in Vancouver probably has to do with escape capital from China. But more importantly, the success of the Chinese diaspora in Vancouver says what happens when the Chinese people become a little bit more free. They become rapidly more rich. And the gradual liberalization in China is the most important thing that everybody in this room, I think, has to look forward to.
Right. Well, Doug, has the largest producer of precious metals in China told you to buy metals too?
They left a message. I haven't gone back, so probably. I think following on Rick's comments, the slowdown in China is not as deleterious to metals consumption as it would have been before. The beta of copper use to the economy has dropped, and the reason for that is that part of the current soon-to-end 5-year plan was a shift away from infrastructure and capital development to a more consumption-led economy, and that started off weak. It accelerated a bit, and it's given some back. But the piece of growth that's been dropping off has been that consumption. And in fact, for the last several years, what kept China going at all was a railway development and grid development. So even with 7% growth, we were looking for something like 4% growth in Chinese copper demand. And we don't see that going away. We don't see that going away until even if China grows at 5. In fact, a case could be made that a further drop in China will actually accelerate a grid growth. It's a very sort of easy way for them to do a true stimulus. Grid last year was 46% of Chinese copper consumption. They're putting down, I think, about 6,000 kilometers of rail just in this year alone. There's a reason to think that they will not just hit that, but maybe exceed that by dint of wanting to finish the current 5-year plan on a high note.
So what you just described, is that demand solid, stays steady, or is that demand goes up and go long?
Well, it's steady, but it's so the first thing is do no more harm. But if you look at the cost structure, which is another point you both touched on, there's also reason to expect some supply destruction. The 90th percentile of copper companies can't make money at $6,000 a ton, which is sadly where we are. Last year, the total cost of gold, the all-in cost of gold, was about $13.50 an ounce, which seems surprising when you look at a just under $1,200 price. Kind of the thing to remember, and I think it will also come up a little later, is that the cash cost of that same gold was more like $750. So two things. One is Rick's concept of the last man standing. Two, if emerging markets get into trouble, they will produce and sell as much hard material as they can, because nobody's going to want their paper.
Let me ask you both to specifically comment on the dollar. And looking out again a year and a half, is it still as strong? Is it stronger? Does the trigger that I talked about happen? What's your viewpoint?
The strength in the dollar has mystified me for 12 months. I think it's probably reflective of the weakness of competitive fiat currencies. It's been referred to as the prettiest mare at the slaughterhouse, which is probably an accurate description. But when you think about the likely competitors, then perhaps the strength in the dollar is understandable. Cynics have described the dollar as an IOU nothing, the unsecured obligation of a society that probably won't repay. Euro has been described as a who owes you nothing. I think the current political malaise in Europe points that out. It's interesting, I think, for this audience to note that things like the gold market, gold has been in a bull market for 14 months in currencies outside the dollar. And I suspect that the decline in the oil price or the copper price, put in the perspective of the strength in the US dollar from other countries' perspectives, is interesting. And I think it goes back to the charts that you showed about 1998 to 2000. The period that we're in right now is eerily similar to me to 1999 and 2000. Very, very, very poor outlook for resources, for materials, at the same time that the background was actually pretty encouraging. And for the same reasons. What we saw in the year 2000 was materials prices bottoming and then beginning to rise in currencies other than the dollar, then rising in tandem with the dollar, and then the dollar rolling over. And everybody, I think, remembers the beginning of the last part of the last decade with some fondness. And while this time probably won't be as dramatic, I think it'll be pleasant, particularly compared to today.
Okay, Doug, save us, because Rick and I start agreeing. I get really worried, you know. So,
well, there's a happy trigger for the dollar to level off and even to start declining. And you laid that out. There's enough growth that the Fed feels comfortable to start raising rates. You would think that would actually that would actually strengthen the dollar, but in our world of current accounts, that doesn't work anymore. But bad news is good news is here as well. But there's also a sad trigger too, which is we're going to start hitting pain thresholds for many of the companies, of the exporting companies that are starting to discuss the rising dollar as the main reason that they're missing their targets. So that news gets out. So at that point, it no longer becomes a one-way bet, and you start having to weigh the real damage you're doing.
Let me give each of you a chance to comment on specific metals and your outlook for those specific metals as I ask our producer to load up the scenarios. So, you know, whether it's aluminum you want to talk about, because that's a good story, or steel, or iron ore, or copper, or whatever it is, if there's one or two that you feel really strongly that will have significant movements in the next 18 months, 24 months, 12 months, you know, versus the other ones either up or down, let me give you a chance to comment on that.
My suspicion is that the outlook in the next 12 months is pretty much bleak for everything. But I wish I could say differently. We are, as Sprott, increasingly attracted to the precious metals because the eerie similarities between what we're going through right now and 2000, 2001, 2002, and also the fact that in terms of all-in sustaining costs, which my colleague has described, the industry is upside down. We are particularly attracted to platinum and palladium in the context of precious metals because although they share all the attributes that other precious metals have, they're also used in industrial processes, which means unlike gold, they go away. They go out tailpipes, they go up smokestacks. And we think over the next 5 years, the best juxtaposition of risk to reward in all of the metals is probably in platinum group metals. Maybe not this year because a declining rand has lowered the cost of production, but looking out, we feel attracted to them. We feel attracted in the base metal space to the zinc market, which has been really from a producer's point of view in liquidation for 3 years. We don't think it could go on much longer. And we feel attracted in the 3 to 4 year time frame to the copper business simply because of declining grades and increased cost of capital. We see a real supply shortage shaping up in the copper business 3 or 4 years ago that won't be able to be addressed by the mining business for 7 or 8 years.
Doug?
I'm more constructive than Rick on copper. I think it's a shorter run. We had been looking at something like 100,000 ton surplus. It's now looking like we could end the year at a 300,000 or 400,000 ton deficit. The costs are hitting, and this is happening. With car sales disappointing pretty significantly over the last 2 quarters, and construction not taking off. Homes and cars now are more copper than they are steel at this point. So a ramp up in those we think is fairly positive. Aluminum we think is going to be a longer story, and we think that there could be pretty significant pain. There's a lot of capacity out there, and energy is cheap, and with China doing all of this grid infrastructure development, right? There's a strong desire to just take that electricity, zap some dirt, and turn it into aluminum. Now, aluminum is going to be more heavily used in cars, certainly U.S. cars and trucks. That's constructed for it. But I would not expect to see aluminum turn around until energy prices get higher. That's the driver of it. In agreement generally that the platinum group metals are probably one of the better places, but those so deeply depend on cars. We prefer a platinum to palladium, just because we tend to think that Europe has more growth potential than the U.S. I don't see gold working out so well. Gold, if there's one relationship that's very strong with gold, it's a relationship, a negative relationship to real interest rates, and I don't see real interest rates going down from here very much, and I don't see hoarding returning back to the U.S. via the ETF space all that quickly. So much depends therefore on Indian demand. And it's just outside of the festival that's coming up next week. I don't see a huge pent-up demand as there was before they lifted their import restrictions.
Great. Well, let's turn to the future and look at some scenarios that might happen in the world. The first one you see up on your screens right now is a world of rising interest rates, but not all rising interest rates are the same. So this is a world of rising interest rates driven by growth. This is a world where the 10-year Treasury moves from where it currently is to up almost normality, which we would argue is about 5%. It's a world where we return to economic growth, but the debt burdens on governments across the globe put a lot of pressure on margins, put a lot of pressure on financial institutions, and especially on leverage to businesses like REITs and so on. In the upper right-hand corner there, you'll see our prediction at IFAM as to what would happen if we return to this environment. We would suggest that, as you can see there, the U.S. Treasury up at pretty close to 5%. We would suggest gold really gets hit hard, down 24%. This, of course, is because gold is the world's insurance policy. Remember, this is a world where everything is getting better. There's real growth out there, so therefore people are less inclined to own that insurance policy. This is a world in which oil starts to rise, not dramatically, but you can see 7% there. This is a world where the stock market actually does pretty good, up 10%. It's a world where GDP is growing, not massively, from 2 to 3%, and it's obviously a world where the U.S. dollar gets stronger. So, Rick, let me start with you. A, do you agree with this scenario as you look at what the various different metals at the bottom that we have put there, gold, silver, steel, aluminum, so on? We're basically saying that gold and silver are going to drop because they're the world's insurance policies. Silver, of course, trades almost always with gold, but with about 2 times the standard deviation, so hence the greater movement in silver. And the industrials do pretty well because there's increasing growth. Would you agree, disagree, and if so, why?
With the caveat that I think the scenario is unlikely, I agree specifically with the conclusions. I think you described gold perfectly. Gold is a sort of social catastrophe insurance, and you're describing a Goldilocks situation. The gold moves as a consequence of a lack of faith, a lack of trust. And in this type of situation, nobody would have any particular reason to have that lack of faith and lack of trust. The U.S. dollar would do very well, as you suggest, would be very poor for gold. My suspicion is that the situation that you described, the scenario that you described, would be better for copper and energy that you described, because I think that the damage to the productive capacity of oil companies and mining companies has been more extreme than people realize, and their ability to increase supply in the face of increasing price and increasing demand would lag, which would be of tremendous benefit, I suspect, to many people in the room.
What are the odds of, you say that scenario is very low. Are you talking about not to pinpoint you, a 10% chance or and why do you think there's little to no chance in it?
You'll notice that I don't have a chart up for people to take pictures of and throw darts at. I'm really a credit analyst, not an economist. But the whole narrative that existed in 2011 in the United States is an example that $14 trillion in on-balance sheet liabilities was unserviceable, that $55 trillion in off-balance sheet liabilities, by the way, I'm 62, I am the embodiment of an off-balance sheet liability, that was unserviceable. The interesting part of the narrative is now that the on-balance sheet liabilities are $18 trillion, they're somehow more serviceable. Now that the off-balance sheet liabilities are $80 trillion, they're somehow more serviceable. I think the scope of increasing interest rates based on growth is problematic because I don't see much out there as a stimulus to growth, probably with the exception of the low oil price. I would love for this set of circumstances to come true. I've been through this set of circumstances before in my career, and it was extremely benign. It was tough to make a mistake. I just think it's unlikely. I don't see evidence of a demand-led economy in the United States. It's difficult for me to understand, and again, I'm not an economist, but it's difficult for me to understand when real workers' wages haven't increased for 20 years, where the increase will come. It's difficult for me to understand in the United States, the market I think we're talking about mostly, where when Congress has put in place the most punitive depreciation schedules in the world and the highest corporate tax rate in the world, where the productive capacity investments will come from that will lead to increased capital allocation per worker and higher wage rates, where that will come from. So I have a difficult time with this scenario. I hope.
Well, I feel more comfortable now that we're disagreeing. So, but we actually agree that you'll see up here on the screen that we have a zero in the upper left-hand corner. It's a zero that's
probability.
That's progress so far. But we still think the key is that rise in interest rate, and that may be triggered by something else.
Something else. Yeah.
Doug, let me turn to the next scenario for you. In this next scenario, we have interest rates rising for a different reason. That's strange. I wonder why that didn't load. There should be a bottom chart on that. I don't know why that didn't load. In this scenario, the interest rates are rising still, but they're increasing for a completely different reason. Here, they're really being driven by commodities and the cost of goods, if you will, going up dramatically. In this type of scenario, you see the 10-year U.S. Treasury still up about 5% on a yield basis. You see gold actually going up instead of down here, up 10%, and of course silver follows that. You see oil up pretty dramatically, up 15%. But unlike the previous scenario, the markets treat it pretty ugly. The stock market drops 20%, GDP growth drops 1.5%, the dollar drops 3%, and so on. I'm sorry in the audience you guys can't see this, but we believe that's actually, oh, it is.
No, that's growth.
No, it isn't.
Driven by growth.
Well, why don't we just
Yeah.
say what it says?
For what it's worth, we have gold and silver going up about 10 to 15%. We have the industrials in kind of a mixed bag. We have steel actually going down caused by the fact there's less GDP, so there's less demand for steel. We have aluminum going up about 19%, and we have copper kind of breaking even. So Doug, what's your thoughts about this? Is it likely to happen? Do you agree with our conclusions?
Right. So look, I mean, I looked at the prior, and this is kind of tied to the same. None of these scenarios up in the upper right-hand corner, or very few of them, are actually all that extreme. I mean, these are one standard deviation moves in gold and oil. Frankly, it's a noise move in the S&P 500 even. I mean, the two pieces that stand out are GDP going from 2.5 down to 1, but even more significant is that the 10-year yield going up close to 5%. That's the one that struck me as part of the one of these things is not like the other game. Because what drives that? Now, in this scenario, it's relatively, I think it's an easier scenario to countenance, which is short rates don't do very much, but the expected inflation basically drives up the 10-year note. So you're building in fairly significant inflation expectations into this world. I don't think this is a radical proposal. I think in that scenario of a very steep yield curve with a significant rise in inflation expectations, I think gold does a lot better than that. Frankly, I think gold we're back up closer to 1,500 than to 1,300. I think you guys work on a beta of silver to gold, and yeah, silver is going to have a higher beta to gold. I don't think it's going to be as significant a beta as you showed in your prior chart, but it's there. Steel should be flat. I think aluminum being up 20%. Yeah, that's reasonable given what you anticipate for the rise in energy prices. I'm surprised that copper's flat. At the end of the day, it will generally move with inflation. So that would in effect be a prediction of a real decline, which I don't see. There's still we had a situation where U.S. global growth was 1%. Copper consumption was not radically different than where it is now. So I'm not sure I see even U.S. GDP growth having a fall that significant, significantly impacting copper consumption. So I think it would be a beneficiary of inflation.
Okay. Rick, let's turn to China again, since it commands so much of our attention in this market. Let's assume that Doug's previous statement that China grows at 7% doesn't happen, and we get a hard landing here, and China's GDP drops all the way down to 4 to 5%. Chinese slowdown brings down, obviously, commodity markets. And as you can see in here, we predicted that in the upper right-hand corner that the U.S. Treasury actually drops. It goes down instead of up to create stimulus. Gold takes a 16% drop. Oil takes another huge hit, down 24% due to less demand in the world. The S&P takes a hit, down 10. GDP growth obviously takes a hit down to only 1.5%. A, you think, what are the chances of a hard landing? And B, do you agree with what would happen to the metals pricings, which are pretty ugly on the bottom of the page?
I think the probability, given China's global competitiveness and their slow political liberalization, I think the probability of a Chinese hard landing is fairly low. I may be talking my book. But to the extent that it occurred, I think that most of your price responses, most of your market responses are accurate, with the exception of the oil price. I think that the seeds for an oil price recovery are being sown simply by today's price relative to today's cost of production. I think that if you don't see $70 US Brent, $70 US WTI in 2 or 3 years, that you'll have enough supply destruction that you'll see $120 WTI 5 or 6 years from now. Even in this type of scenario, I think one of the things we forget is the impact on supply and price over time of supply destruction. So with regards to every other of your market response predictions, I think they're probably fairly accurate, but I think the seeds are being sown of an oil price recovery almost irrespective.
Okay. Well, let's turn to another scenario, one that's looming over us that I think we all pray doesn't happen, but we should talk about it. And that's a true global conflict here where the U.S. or Israel engage in an armed conflict with Iran. This is obviously a repeat of the scenario of the Gulf Wars, and you have skyrocketing energy prices, oil production is hurt, interest rates drop to encourage some economic activity as, everybody goes into freeze mode, if you will. So you can see our predictions up there. We think the U.S. Treasury drops in that market. Oil obviously skyrockets 177% to 140. The S&P takes a big drop, and the U.S. dollar gets really strong. So we think, the insurance policies of the world, gold and silver, go up a lot at that point in time, but obviously the industrial metals get hurt by lack of demand. Doug, agree, disagree? What do you think the likelihood of this scenario developing is?
So what drives this? I actually think it's certainly the U.S. piece is a very low probability scenario. If there's been one hallmark of Obama foreign policy, it's been in engagement with Iran to the harm of Israel and the Saudis. So I have a feeling we won't be going to war with Iran. I think the entirety of the nuclear deal is a 10-year kick the can down the road to another president. Israel coming in and getting fed up and taking out, say, the Iraq facility, if they fear that is secretly being ramped up. That's pretty much the only scenario in which I think Israel goes in, because if they wait until they can start making the plutonium in that reactor, then the casualties would just be astronomical. In addition, I think that this scenario of oil going from $50 to 140 it's not just. It obviously is not believed to just be contained to Iran, because Iran's production is significantly constrained now by sanctions and by their own diminished infrastructure. So this to me seems like a scenario in which there's a war that effectively envelops the entirety of the Middle East, and we are kind of possibly set up for that, with some involvement by Russia and certainly significant interest by China. Yeah, I think this is a world of ugliness, and I think you're probably almost understated in the harm to the S&P and to the industrial metals.
Great. Well, Rick, let's conclude on kind of my core central theme, if you will, but this is a scenario in which the dollar kind of steadily declines. At some point in time, the dollar can't go up and be the world's barometer forever on the high side, and in that world, obviously, when the dollar's declining, it's a benefit to major exporters and commodities like gold and oil. So you can see in there we've got gold going up 16%. We've got oil going up 35%, up to about $68. We've got the S&P performing well, and obviously GDP does pretty well too in that environment. Two same questions. What's the likelihood of this happening over the next 2, 3, 4 years? What's the do you agree with the scenarios that at the bottom paint an awfully good picture for metals across the board?
I think I agree that a U.S. dollar decline is in the cards, and I pray that it's a benign decline. I keep in my own mind, this isn't Sprott's point of view, by the way, this is my point of view, I keep hearkening back to the global financial crisis and the liquidity crisis and confidence, and I keep wondering how many of the underlying causes of that crisis have been dealt with. And I keep in the back of my mind being nervous about the fact that if you didn't cure the cause of something, that you didn't reduce the probability of it occurring. So with that caveat, I think the situation you describe is the most likely of the situations that you proposed, and I think the response that you have put in place is also probably an appropriate response. Again, I would suggest that the dollar is probably a contributing factor, but a less important factor than the supply destruction. The other thing that I want to point out to the room is I think perhaps the inevitability of not merely a dollar decline, but a fiat currency decline. I had the pleasure in October of spending a fair bit of time with a bunch of other people, with Alan Greenspan. And he said something very interesting. He said that a strong dollar is incompatible with a representative democracy. Democracies are made up of more spenders than savers. And that, in fact, fiscal policy will always favor the spenders over the savers. And that more people are in favor of benefits than they are strong currencies. And that there is a sort of an inevitability to the depreciation of the purchasing power of the denominator, the US dollar. I was struck a couple of weeks ago driving to work, and many of the audience will empathize with this, and I'll get to the point quickly, I promise. I was driving past a Motel 6 that was so named because in my early adulthood I could stay there for $6. Not all about me. But the sign I drove by on the way to work said Motel 6, $69.95. Now, there's only two possible explanations for this. One is that the utility of a room at Motel 6 has increased 11-fold during the period of my adulthood, or the denominator has depreciated by 95%. And I'll leave it to the audience. I know most of you haven't done due diligence on Motel 6s recently.
Nor stayed in a Motel 6.
That's my point. But
It's much better.
I would suggest to you that the rooms aren't 11 times the size, and I suspect the sheets haven't changed since it was $6. And so I would point out, just with the Motel 6 metaphor, that my suspicion is that a decline in the purchasing power of the US dollar, benign or otherwise, is in the cards.
I think we know why Sprott makes so much money now. It's your frugalness and where you stay. Well, we're running out of time, and unfortunately we can't get to all my fun scenarios like the crazy dictator and so on. But Mr. Chairman, I don't know if we have time for the questions that came out from the audience. These are some that were emailed to me, or are we completely out? Completely out. Well, then we will thank you very much for your time, and ISRI is a special organization to me, so it's a real honor to have been invited, and I look forward to visiting with all of you.